All right, stock more bonds. Stephen Nash is Director, Strategy and Market Development at FIIG Securities. He joins us live from our studios down in Sydney. Stephen, good to see you and appreciate your time. We'll talk about JGBs and Japanese paper in just a bit, but state your case for fixed income broadly right now over equities.
Look, I think going forward, we've had one official institution after the other downgrading the outlook for growth. I think there seems to be quite a stark contrast between official forecasts and private sector forecasts, with official forecasts being quite conservative on growth. Private sector, on the other hand, seems to be persistently positive on growth. For us, we would go more with the official forecasts and look for lower growth and possibly new lows in bonds in 2013. That doesn't mean bonds are going to be rallying forever, of course, but looking for a new low in the Australian 10-year bond, I think it's quite a fair estimate for 2013.
Yeah, Stephen, bonds have done very well in 2012 as people look for a reliable source of yield. But I mean, you do have data, official data as well, ticking higher in the United States. They just revised up their quarterly GDP to 2.7%. Some of the data we've been getting out of China has certainly been encouraging, and it looks like they've manufactured or engineered a soft landing. And perhaps it's time for investors to start taking on a little bit more risk. What's your view on that? Perhaps it's going to be a tough year for bonds, some are starting to say?
Look, there's been a lot of commentators talking about a bond crash as soon as possible. A lot of these commentators don't participate in the bond market, are basically proponents of equities, and you can expect that they would be negative on an asset class that has really outshone them for quite a while. I would imagine that, again, we're going to have a fairly tricky year for equities, a lot of risk with equities, not that much return. Broadly, with that low growth scenario, equities will find it difficult to continue to rally strongly. Yes, there's been some improvement in US statistics, but I think in terms of bond markets anticipating a tightening, that's some way off, and the Fed continually tells us to be very patient on any increase in Fed funds rate. They're very aware of what happened in 93, 94, and they've really changed their communication strategy, and I think that's a very important thing the market's really not appreciating at this point.
Okay, there does seem to be growing nervousness about government debt. And one story that's appeared quite a bit over the past month or so has been hedge fund managers saying, okay, this is the year, 2013 will be the year that you short JGBs, and we're getting comments from bankers, as Marty just mentioned, that they're getting a little bit nervous about their exposure as well. What's your view on the JGB market? Again,
JGBs have been a classic market where people have tried to short it and have got it wrong again and again. We've seen a continued low growth environment in Japan. Japan now faces a reduced demand for its exports from China, and China's facing a lot of difficulties from a very depressed European market. I think for the global economy in 2013, Europe is really going to be a focus here. Europe will experience a rolling recession in 2013, which I can't really see will be offset in other areas at this stage. So whatever growth we get in the US and other areas, it'll probably be offset to a large extent by what's going on in Europe.
Speaking of which, Stephen, is there a case for the peripheral sovereign debt from the likes of Spain and Italy, arguably backstopped by the ECB now, above and beyond the core quality credit in Germany, where we are seeing negative yields?
Look, I think what's happening in Europe is that the core countries are getting drawn into the recession. We've seen further downgrades to France. I would expect at some point there'll be some moves on the German rating as the recession worsens. So being positive on bonds is probably not the right way to go right now. In terms of the peripheral yields, I think they will, yes, will be supported, but with the recent Greek negotiations, I think it shows how difficult it has been for the Europeans to agree on rather minor negotiations with regard to Greece. The real problems remain Spain and Italy, but mainly Spain at this point. So the market will anticipate over 2013 there will be further difficulties. So it's not a one-way bet with Spain. In other words, you've got to be very careful and watch your timing there with those spreads right now.
Yeah, okay, which sort of raises the point. I mean, it's been a bit of a remarkable week that was, hasn't it, Stephen? The strength we've seen in the euro, and also if you take a look at Italian paper, the 10-year, it's back to about 4.5%. How long is this good for?
Look, I'm sure that the ECB will be reliable in terms of its support for the market. It really hasn't been tested at this point. I think, again, in 2013, with this rolling recession, with further strains in the Spanish market, that we will see some upside. So I would be quite careful with regard to peripheral spreads. I think given the momentum in the market, you could enter the market on the long side, but be very careful about any problems with regard to the Spanish market in particular. And we haven't even started talking about other countries like Portugal and others which are feeling the strain significantly right now.
Okay, Stephen, what's your advice on junk bonds?
I think the high yield market has performed quite well of late. We've seen almost record levels of issuance in corporate markets and also the high yield space. Compression of spreads, I think, at this point has probably come as much as it will. I'd probably prefer to be more conservative on credit. I think the outlook for equities with the market basically revising expectations after QE3 is probably a little bit more downside. So in terms of spreads, I wouldn't be backing high yield spreads right now. We'd prefer to be in the more conservative credits, investment grade and up at this point.
And I want to get back to Spain. You just mentioned it a moment ago. What happens to Spanish paper if they put their hand out and they ask for a bailout? Because the other countries that have done that, they've seen foreign flows just dry up. Will the same thing happen this time around?
Look, I think if Spain does what the market wants it to do, which is really ask for that bailout, I think that would be quite positive. Yes, it will have implications for foreign flows into the market, but really it's inevitable, I think, that Spain has to approach the ECB and ask for that bailout. The market has been waiting for this for quite a while. The longer it goes on, the more potential for some unfortunate incident to occur and we get another blowout in spreads. Now, if we were to get another blowout in peripheral spreads, these countries are already in very severe recessions, and it would be negative again for those countries with Spanish unemployment at almost 25%. It's not a time for Spain to resist, I suppose, what the inevitable is and to give up some sovereignty to some extent and ask for that bailout.
Okay, Stephen, thank you so much for joining us this morning. We appreciate it.
Okay.
Stephen Nash there of FIIG Securities joining